As the market has wrapped up its main session for June 11, 2026, Micron Technology closed at a striking $995.87 per share, locking in a massive intraday surge of 11.66% and adding over $103 to its price in a single day of aggressive trading. While standard retail traders are staring at that near $1,000 milestone and assuming this is just another standard lift from the broader semiconductor tide, the reality underneath this massive move is far more intense. Right now, a quiet structural squeeze is happening within the hardware pipeline that most standard online investment newsletters are completely overlooking. The widespread belief across major investing sites is that the chip sector is simply getting a regular valuation lift because large data centers keep buying hardware. The market expects a predictable line of growth, where supply eventually meets demand, margins stabilize, and the chip makers slide back into their traditional cyclical patterns. But the reality challenging this narrative is that commodity memory is effectively dead, replaced by a permanent supply deficit in high-bandwidth hardware that has top-tier buyers panicking. Major Wall Street firms like Wolfe Research just adjusted their targets to $1,250 because the math on raw commodity pricing shows that memory components could triple in contract value before the end of the year. This is no longer a standard cyclical upswing. It is a fundamental restructuring of how hardware allocation works, forcing retail platforms from standard individual brokerage accounts to advanced interactive broker stock trading platforms to completely reassess what this business is actually worth. When you look at recent stock movement, the sheer volume tells a story of aggressive accumulation. Yesterday's trading session saw a heavy influx of capital that reversed 2 consecutive days of minor cooling in the tech sector. This was not a soft bounce driven by small retail accounts on a basic Robinhood stock trading app. It was a highly directional institutional sweep. The broader semiconductor group has seen whipsaws all week, yet the underlying trading volumes for this specific asset reveal that whenever the price dips even slightly, large fund managers step in to absorb the supply. This institutional activity directly signals that Wall Street is ignoring short-term macroeconomic pressures like shifting interest rate expectations or localized supply chain bottlenecks because they are focused entirely on the immediate earnings upside. The tension between expectation and reality becomes glaringly obvious when analyzing recent quarterly figures. The market expected a solid performance, but the company delivered a staggering revenue report of $23.86 billion, representing a massive 196% lift year over year. Even more disruptive to the bear case was the adjusted earnings per share hitting $12.20, obliterating the consensus estimate of $9.31. When a massive hardware manufacturer beats expectations by that wide of a margin, it changes the entire momentum of the sector. Retail investors utilizing SoFi Active Investing or tracking their portfolios on Fidelity Investments apps are watching guidance for the upcoming quarter climb toward $33.5 billion. Think about that volume of business for a moment. Gross margins are projected to hover near 81%. For a hardware business that traditionally operated on thin, volatile single-digit or low double-digit margins during down cycles, an 81% gross margin looks more like a high-end software enterprise than a silicon foundry. This financial acceleration explains why the stock has posted a breathtaking 223% gain since the start of the year, essentially tripling in value over a 6-month stretch. If you look at the options market and modern prediction platforms, there is an intense battle happening right now. A massive cluster of open interest was betting against the stock crossing the $1,000 mark by the end of June, treating it as a psychological ceiling. Yet the price action is aggressively forcing short positions to cover, creating a secondary layer of buying pressure that fuels these double-digit daily swings. Sector momentum is heavily concentrated in companies that control physical capacity. While a lot of retail speculative capital flows into popular retail choices like Tesla stock or Apple stock, or moves rapidly through high-volume options on Nvidia stock, the institutional desks are realizing that those advanced processors cannot function without the massive pools of specialized memory that only a few foundries globally can produce. To truly understand why the stock is behaving this way, we have to look at what the business actually does underneath the ticker symbol. The company designs, manufactures, and sells dynamic random access memory, known as DRAM, alongside flash storage memory, known as NAND. Historically, this was a highly commoditized, deeply volatile industry. A computer or a phone needed a few gigabytes of RAM. Companies built giant foundries, oversupplied the market, prices collapsed, and these chip companies would bleed cash for 6 quarters before the cycle reset. That legacy business model is the reason many conservative investors using a basic SoFi robo-advisor or standard intelligent portfolio allocations have historically been wary of holding heavy memory positions long-term. They remember the brutal down cycles where inventory write-outs ruined balance sheets. However, the modern business model has shifted from selling generic storage components to producing custom, high-layer, high-bandwidth memory, specifically HBM3E and the upcoming HBM4 ecosystems. This specialized hardware is physically stacked and integrated directly alongside massive AI accelerators. Nvidia recently solidified this shift by confirming the company as a key verified partner for its next-generation architecture. This means the inventory is no longer built on speculation and sold on the open spot market. Instead, the physical production capacity for the entirety of 2026 is already entirely sold out under rigid
rigid, long-term institutional contracts. The customer base is literally paying premiums up front just to secure a spot in the assembly line. Comment below how many shares of Micron Technology you currently hold in your portfolio right now, or if you are leaning toward automated solutions like Schwab Intelligent Portfolios to manage your semiconductor exposure instead. This shift completely rewrites the future outlook for the company, creating a distinct divergence between the traditional bears and the current reality. The standard bearish argument is that this run is entirely parabolic and unsustainable. Skeptics point to past performance, arguing that high pricing always triggers a wave of factory expansions across the industry, which inevitably leads to a massive glut of cheap chips. They look at executive stock disposals from earlier this spring, where top leadership trimmed some personal holdings, and interpret it as a sign that the insider peak is already behind us. In a normal world, that expectation would be completely accurate. Parabolic moves with a high beta of over 2 usually invite severe corrections. Yet the counter-reality is that building new clean rooms and scaling advanced lithography nodes takes years and billions of dollars in specialized capital expenditure. The structural reality of the current market is an insatiable demand from cloud infrastructure hyperscalers that shows zero signs of cooling before 2028 or 2029. The macro environment is structurally undersupplied because the physical footprint required to manufacture high-bandwidth chips is significantly larger than traditional memory, effectively cutting the total wafer output of existing factories in half. Even if competitors try to flood the market with low-grade components, they cannot replicate the enterprise-grade TAC required for modern high-performance clusters. This gives the firm unprecedented pricing power that could easily sustain these massive net margins far longer than anyone anticipated. For individuals navigating online investing, whether you are utilizing self-investing strategies through a Fidelity trading platform or testing tactical sector plays via interactive brokers' fee structures, the choice comes down to how you view this structural tension. If you believe the traditional hardware cycle is unbroken, this $1,000 level looks incredibly risky. But if you look at the actual contract structures, the multi-year partnerships, and the massive gross margin guidance, the reality suggests that the market is still pricing this like a cyclical industrial company, rather than a critical infrastructure monopoly. In summary, the core narrative surrounding this chip giant is a classic battle between historical expectations and structural realities. The market expects the old rules of silicon volatility to eventually snap the price back down to earth, viewing the recent 11% daily jump as pure euphoria. But the underlying data, the massive earnings beats, the completely sold-out order books, and the high-margin enterprise contracts reveals a business that has fundamentally altered its financial trajectory. While retail platforms will continue to see high volatility and rapid daily swings, the deeper institutional accumulation shows that the elite capital is betting on a prolonged, highly profitable, high-bandwidth supercycle that is completely redefining the value of modern computing infrastructure. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.